You send $500 overseas. Minutes later, the recipient holds digital dollars. Behind that payment sits a financial machine the Federal Reserve valued at roughly $320 billion in 2026. It holds traditional assets, earns interest for private issuers, and promises that each token can return as a real dollar. What happens when everyone asks at once? When a new dollar-backed stablecoin is issued, two transactions effectively occur. The user receives a digital token. The issuer receives real money and places the backing into reserve assets, bank deposits, treasury bills, government money market funds, or similar liquid instruments. The token travels across blockchains. The reserve stays inside traditional finance. That connection is what turns a crypto product into a question for the entire financial system. By May 2026, the Federal Reserve described the stablecoin market as roughly $320 billion. Since early 2025, the market had grown by more than 50%, and almost all of its economic promise depends on confidence in a very simple exchange rate: $1 in, $1 out. Calling stablecoins shadow banks requires care. They are not ordinary banks. They generally do not use reserves to make mortgages or business loans in the same way commercial banks do. But they issue money-like liabilities outside the traditional deposit system and invest the corresponding assets. That makes the comparison useful. It also makes the differences important. The original problem was crypto volatility. Bitcoin could move sharply while traders waited for money to travel through banking rails. Tether launched its dollar token in 2014, partly to let value move between crypto markets without repeatedly returning to bank accounts. USDC followed in 2018. What began as settlement infrastructure for traders gradually became something broader: a portable dollar balance for the internet. For a business, stablecoins can shorten cross-border settlement. For a trader, they provide dollar liquidity without leaving a blockchain. For someone living with an unstable local currency, they can provide easier access to a dollar-denominated asset. The International Monetary Fund says stablecoins could make some remittances and international payments faster and cheaper. That utility helps explain why the system keeps growing. Now follow the interest. Circle held an average of roughly $75 billion of USDC in circulation during the first quarter of 2026. The assets backing those tokens earned interest. Circle reported $652.5 million of reserve income in just 3 months. Reserve income represented 94% of its total revenue. That is the economic engine. The holder gets a token designed to remain worth $1. The reserve assets can earn interest. The issuer captures that reserve income, although some may be shared with distribution partners. Economically, users have supplied the funding base. At scale, even a modest interest rate becomes extremely valuable. Stablecoin growth therefore creates two things simultaneously: more digital dollars and more investable reserves. At the end of March 2026, USDC circulation stood at about $77 billion. Circle said roughly 86% of its USDC reserves were inside the Circle Reserve Fund, a government money market fund managed by BlackRock. That fund holds short-dated U.S. Treasury securities, overnight Treasury repurchase agreements, and cash. The blockchain token is new. The assets behind it are remarkably traditional. Then, there is Tether. At March 31st, 2026, Tether reported approximately $183 billion of token-related liabilities. Its direct and indirect exposure to U.S. Treasury bills was approximately $141 billion. It also reported around $20 billion of physical gold and roughly $7 billion of Bitcoin in its reserves. The largest stablecoin is now also a significant global investor. This is where the story leaves crypto. The IMF estimates that stablecoins already hold roughly 2% of outstanding U.S. Treasury bills. Treasury officials openly monitor the sector as a source of demand. When new stablecoins are issued and the incoming dollars are invested in bills, private digital money can create additional demand for public American debt. Crypto liquidity enters. Treasury demand comes out. That phrase can easily become misleading. Stablecoin companies do not give money directly to the government every time they mint a token. They purchase Treasury securities in primary or secondary markets, just like many funds, banks, companies, and foreign investors. Their demand can make government bills easier to place, but they are one buyer among many. That distinction matters. Suppose an investor moves $10,000 from a money market fund into a stablecoin. The money market fund may sell Treasury bills. The stablecoin issuer may then buy Treasury bills. Stablecoin supply increased. Net Treasury demand may barely change. The Treasury Borrowing Advisory Committee has explicitly warned that the source of stablecoin inflows determines whether the government receives genuinely new demand. The effect becomes stronger when stablecoin growth brings dollars from somewhere that was not already holding Treasury bills. Researchers at the International Monetary Fund found measurable effects at the short end of the Treasury market. Their 2026 study estimated that a 1% increase in combined USDT and USDC capitalization reduced the one-month Treasury bill yield by about 1.9 basis points over time. Small movement, enormous market. The relationship is no longer accidental. When the Genius Act became law in July 2025, Treasury Secretary Scott Bessent explicitly argued that stablecoin expansion could increase demand for U.S. Treasuries. Later, Treasury officials continued monitoring stablecoins as a growing buyer of short-term government debt. A technology created for crypto trading had become relevant to sovereign financing. The Genius Act created a new legal architecture. Once its core requirements take effect, permitted U.S. payment stablecoin issuers will have to maintain identifiable reserves of at least $1 for every dollar of stablecoins outstanding. Permitted assets include cash, qualifying bank deposits, short-term treasuries, certain Treasury-backed repurchase agreements, and qualifying government money market funds. The law also requires redemption policies and regular reserve disclosure. The aim is straightforward. Make the promise more credible. Stablecoin issuers need assets that earn something but can become cash quickly. A 30-year bond is inconvenient if billions of tokens arrive for redemption tomorrow. A Treasury bill maturing within weeks is different. It is short-term, widely traded, and backed by the U.S. government. Stablecoins therefore create natural demand for the shortest part of the Treasury market. That is useful during normal conditions. Runs are where the design gets tested. Imagine rumors spread about a stablecoin issuer. Some holders sell the token on exchanges. Its price slips below $1. Professional traders may buy at the discount and redeem directly with the issuer for a full dollar. That arbitrage normally pulls the price back toward $1, but it only works smoothly while redemption channels remain open and confidence in the reserves remains intact. Now imagine $10 billion of redemption requests arrive rapidly. The issuer needs cash. Bank deposits can be withdrawn. Short Treasury bills can mature or be sold. Money market fund shares can be redeemed. If the reserves are genuinely liquid, the system should absorb the pressure. But every redemption converts an on-chain panic into a transaction inside traditional financial markets. The run crosses the boundary. We have already seen that boundary fail. In March 2023, Circle disclosed that $3.3 billion of USDC reserves were trapped at Silicon Valley Bank after regulators took control. That was around 8% of USDC reserves at the time. The stablecoin began losing its peg. One digital dollar suddenly traded for substantially less than one real dollar. Federal Reserve researchers later reconstructed the event. At its lowest point, USDC traded near 86 cents. The reserves had not all disappeared. The problem was uncertainty about whether Circle could access enough of them and whether redemption would work normally. That difference is crucial. A stablecoin can be well backed on paper and still experience a liquidity crisis if access to the backing becomes doubtful. The blockchain kept trading through the weekend. Parts of the banking system did not. Circle explained that issuance and redemption were constrained by U.S. banking hours. So traders could sell USDC continuously while the primary mechanism designed to convert it back into dollars was restricted. Digital money was operating 24 hours a day. Its reserve infrastructure was not. The stress did not remain inside USDC. DAI, another stablecoin, had automated facilities allowing users to exchange it against USDC and other stablecoins. As USDC weakened, those mechanisms transmitted stress into DAI and smaller tokens. The Federal Reserve later described the episode as evidence of two-way contagion between traditional banking and decentralized finance. One failed bank reached several digital currencies. On March 12, 2023, the Treasury, Federal Reserve, and Federal Deposit Insurance Corporation announced that all Silicon Valley Bank depositors would have access to their money. Circle's trapped reserves became available. Confidence returned. USDC recovered its peg. The episode did not prove that every stablecoin run requires government intervention. It proved something narrower. Reserve quality alone does not eliminate operational and counterparty risk. Tether faced a different stress event during the crypto market turmoil of 2022. The company says it processed about $10 billion of redemptions within roughly 1 week. It survived. That matters because a stablecoin issuer has to do more than report assets greater than liabilities. It has to transform those assets into cash when holders demand it. Solvency is the balance sheet. Liquidity is the exit door. The largest issuers have shifted toward more liquid reserve structures. The Federal Reserve noted in April 2026 that stablecoins with safer and more liquid backing had seen stronger adoption. Once implemented, the Genius Act is designed to push permitted payment stablecoins toward high-quality reserves, redemption procedures, monthly disclosures, and limits on reusing reserve assets. Those reforms reduce some of the vulnerabilities exposed in earlier crises. They do not abolish runs. Today, the market is still small compared with the banking system or the Treasury market. But scale changes consequences. The IMF warns that if stablecoins eventually grow into the trillions, a run could force enough reserve selling to affect Treasury bill and repurchase markets. Those markets are not obscure corners of finance. They help determine short-term funding conditions across the global dollar system. The full mechanism now looks like this. A user buys a stablecoin. The issuer receives dollars. The issuer buys Treasury bills. The U.S. government receives a broader investor base for its debt. The issuer earns interest. The stablecoin becomes more useful and attracts more users. More users create more reserves. More reserves can create more Treasury demand. Each layer supports the next. During growth, the circle looks efficient. During a run, every arrow reverses. Users demand dollars. The issuer needs liquidity. Reserve assets may be sold. Treasury demand becomes Treasury supply. Banks holding reserve deposits can lose funding. Crypto markets lose a settlement asset. If the sector becomes large enough, the same mechanism that supports short-term government debt in normal times could amplify stress during exceptional ones. Stablecoins can also pull money away from ordinary bank deposits. That matters because banks use deposits as an important funding source for loans. If households and businesses increasingly hold stablecoins instead of deposits, some money may migrate from bank balance sheets toward Treasury-backed reserve pools. The effect is not automatically harmful, but it changes where money travels. Payment innovation can alter credit allocation. The benefits are real. Stablecoins can make dollar payments programmable. They can operate across borders outside traditional banking hours. They can improve access where correspondent banking is expensive or slow. High-quality reserves can make them considerably simpler than highly leveraged banks. Regulation can strengthen redemption and disclosure. A financial instrument does not become dangerous merely because it is new. The real question is how large society wants it to become. That leads to the debate regulators have not fully resolved. Should privately issued digital dollars become a major global payment layer if their reserves also become important buyers of government debt? Growth can strengthen dollar reach and Treasury demand. Concentration can also create new points of failure. The trade-off is not crypto versus banking. It is efficiency versus resilience at a much larger scale. Return to the $500 you sent at the beginning. To you, it was a payment. To the blockchain, it was a token transfer. To the issuer, it was part of a liability. Behind that liability sat reserves earning income inside the traditional financial system. And part of that reserve system may ultimately finance the same government debt held by banks, pensions, and money market funds. The layers are becoming difficult to separate. The stablecoin system is not an alternative universe replacing traditional finance. It is becoming another entrance into it. Digital dollars can expand access to the U.S. currency, create demand for Treasury bills, and make global payments faster. But every promise of instant redemption creates an obligation to produce real dollars when confidence disappears. That is the central bargain. Stablecoins move at blockchain speed. Their safety still depends on the assets behind them.